Are you tired of handing the IRS more of your hard-earned cash than you need to? Well, if your business is structured incorrectly, that's exactly what you will keep doing. Being recognized as an S corporation could save you thousands, but only if you're truly ready for it. So in this video, we're going to have an honest discussion about whether an S Corp is right for you and how it can help you save thousands upon thousands on your tax bill every single year. I'll break down who an S Corp really benefits, who shouldn't jump in just yet, the biggest mistakes to avoid so you don't end up regretting this move. And because the math has to math, if you stick around to the end, I'll show you exactly why people absolutely love themselves an S Corp. So, hey there, my name is Jean Tony. I'm an enrolled agent and business finance coach. I help service-based entrepreneurs get clear about which business structure works best and how to organize business finances so you can maximize your cash flow. Now, if you don't remember anything else from this video, please remember the tax code is written in favor of job creators and investors. And guess what? That is you. As a business owner, you can legally choose how much of your income will be taxed. A lot of entrepreneurs don't realize how much power they have over how much taxes or how few taxes they pay. And that's why we're talking about S Corps today. It's an amazing way the tax code allows you to keep more profit in your pocket, but only if your business is set up for it. Grab a pen and some paper and let's dive in, all right? Now, I want to start by clearing up something. An S Corp is not a type of business. It's not a business entity. Sole proprietors, LLCs, partnerships, and C corporations, those are business entities that are determined when you submit the application to your Secretary of State at the state level, okay? Those are business entities. So what the heck is an S Corp? Well, an S Corp is a special tax election on the federal level that the IRS lets you use. It's a tax election that tells the IRS that you are entitled to certain tax advantages. So your LLC can either be taxed as a sole proprietor or your LLC can be taxed as an S Corp. Sole proprietors use a Schedule C on your personal federal tax return, and S corporations use a Form 1120S. Now, it's still an LLC on the state level, but completely different tax treatments on the federal level. And if you think about it, it's the same process when you want to turn your state-approved nonprofit into a tax-exempt 501c3 organization. You became a nonprofit or a charity on the state level and then applied to become tax-exempt on the federal level. So there's a similarity in how this process is handled, okay? Now, with that said, let's talk about who may not be ready for the S Corp, okay? In my experience, there are three types of entrepreneurs who should not apply to become an S Corp. The first is the entrepreneur who has inconsistent income, or your income is under $30,000 to $50,000 range, okay? You will find that the extra admin costs, extra tax forms, and annual fees are going to eat up whatever savings you get from being an S Corp. And now I hear so many influencers telling their followers to apply for an S Corp when they first get started, and it's the hot new thing, especially since, during the pandemic. And the compliance issues, I'm telling you, just aren't worth the headache when you're first starting out, especially if your revenue isn't stable yet, okay? So hold off on applying to become an S Corp if your income is inconsistent or falls below that $30,000 to $50,000 threshold, okay? The second type of entrepreneur is the entrepreneur who treat your business like a casual side hustle. You're mixing personal spending with business funds everywhere. Your record keeping is out of whack. S Corp compliance will be a total nightmare. So hold off until you get your financial life together, okay? And if you're a real estate investor, sorry, you're on my list as well, all right? And S Corp isn't your best bet either. Why? Well, the biggest reason is that the S Corp can complicate things when you're selling your properties by triggering capital gains taxes on the appreciation of your property. You're usually better off with an LLC or partnership structure if you have a partner that's built for rental holdings. But not everybody is holding on to their rental properties. So before you jump in, talk to a real estate savvy tax pro who can walk you through the right setup for your investments. Again, S Corps are not for everybody, but they're game changers for those that can take advantage of it. All right. So now, who should consider an S Corp? In my experience, there are two types of entrepreneurs that are ready for an S Corp. Okay. The first is, and let me just say this, your financially savvy CEO mindset is everything. Your mindset is everything. So if you're serious about getting your finances in order, and number two, you're generating consistent income, so you're well above that $70,000 or even $80,000, $100,000 or more threshold, I would encourage you to use the S Corp to stack your cash, maximize your impact, and build a solid legacy. Now, if you're a serious high income earner, I know, like I said, the math has the math. So stick to the end of the video and I'm going to show you how much of a tax advantage this can be for you, okay? And please don't forget to like and subscribe to my channel to tell YouTube this video is bringing you value. All right. I need to make sure you know 3 common mistakes new S Corp owners make before we move on, all right? Mistake number 1 is not being able to run your payroll properly, okay? You're going to have to manage your payroll when you become an S Corp. So this means your business has to have a steady cash flow so you can pay yourself at least once or twice a month, all right? Don't try to game the system here by giving yourself a tiny salary like $5,000 or $10,000 when you're actually earning 6 figures, okay? The IRS looks for something called reasonable compensation. And if they catch you skimping, you can face penalties and big back taxes. I'm gonna cover that a little bit more in just a moment, okay? Mistake number 2 is ignoring state rules. Some states like California impose minimum franchise taxes or fees on S Corps. Others, like Texas, have different franchise tax structures. Missing these rules and not understanding your state laws can get your S Corp status revoked. All right? Serious. Now, mistake number 3 is forgetting payroll deadlines. Unlike a sole proprietorship, an S Corp means real payroll reporting. I've been talking about that, right? Quarterly forms, W-2s, the works, all of that is included in your administrative tasks once you become an S Corp. Skipping on or being late on these can rack up fines that will wipe out your tax savings fast. So don't sabotage your efforts, okay? Now, we have covered who the S Corp is for and who should hold off. We have covered mistakes I need you to look out for. So now, it is time to talk about one of the main benefits of the S Corp. Why are so many people so infatuated with this S Corp thing? I mean, why go through the hassle of filing extra forms and running payroll? Well, when you're using your Schedule C, you're paying self-employment tax on a good chunk of your taxable income. By the way, self-employment taxes are Medicare and Social Security taxes, okay? That's what we're talking about here. Medicare and Social Security taxes combined, that equals your self-employment taxes. So when you become an S Corp, you can drastically reduce how much you contribute to these payroll taxes by thousands. And high income earners that are not relying on the government for retirement and are self-funding their long-term care, so they're not worried about Medicare, they're not worried about Social Security, they jump all over this, okay? Now, I want to look at an example to show you exactly where the benefits come in, all right? If you're an LLC, taxed as a sole proprietor, earning $150,000 in this example, you might be looking at roughly 15.3% in self-employment taxes on the entire $150,000, right? So that's about $23,000 just in self-employment taxes on top of your regular income tax and state taxes as well. But if you elected to be taxed as an S Corp, we split that $150,000 up into two buckets, one that is taxed and one that won't be touched by the self-employment tax. You only pay payroll taxes on your reasonable salary, not on your entire $150,000 income. So let's say out of the $150,000, you can split it up into two buckets, right? So one bucket, you're going to pay yourself a $60,000 salary. The rest, $90,000, is going to put it in another bucket, and that's going to be labeled as distributions, which generally are not hit with that same 15.3% at all. Even after you factor in payroll, even after you factor in administrative costs, you're still saving thousands of dollars. I mean, look at this. In this one example, this taxpayer is saving over a little over $13,000 here. When you compare what they would pay as a sole proprietor versus what they would pay as a S Corp, the tax advantages add up quickly when your taxable income moves beyond six figures as well, okay? That's why if you're truly ready, meaning you have a stable income, can handle payroll, won't cut corners on compliance because you got that financially savvy CEO mindset going, the S Corp is truly a game changer for entrepreneurs that are out there killing it and don't want to be hit with a huge tax bill, all right? Now, if your income is booming, don't miss my other video on how to avoid a huge tax bill when your business income skyrockets. This is where I break down additional strategies to help you lower your tax bill. I'll link that in the description below. That video pairs perfectly with what we've covered here, okay? Thanks so much for watching. If you found this helpful, hit that like button and subscribe for more finance and tax tips to keep your hard-earned revenue in your pocket. Remember, if your business is leveling up, your finances should too, all right? See you in the next video.